Good afternoon, everybody. I'm Jennifer Litwin, the head of relationship management at Greenwich Associates. And while my illustrious colleagues are getting suited up with their microphones, I'll just give a little bit of an introduction. I'm really delighted to be here, very excited about this, and I'm going to be sharing some of our about to be released data from our most recent global foreign exchange study. So those of you who have stalked me on the new and very cool app for this conference and read my bio know that I lead a double professional life. So what that means is in the unlikely event that we hear crickets and there's any awkward silences during this next panel, I'm fully prepared at any moment to break into an operatic aria. And I do take requests. That said, our panel has actually decided that we'd love to have any questions that you may have throughout the discussion, so please feel free to jump in. Greenwich Associates deals in information exchange. We conduct extensive market research interviews globally with more than 5,000 portfolio managers, traders, research analysts, and corporate treasurers every year. Our markets advisory services encompasses all key product sectors of FICC and equities, and I cover buy-side investors. My primary responsibility at GA is to encourage participation in these research studies. Our global foreign exchange research takes place annually between September and November. Now, I do see a number of you here who worked with us during our most recent round of research. Many thanks to you. And I see a few of you who didn't. I know who you are. And I really hope that you will consider doing so in the future. And I'm happy to discuss with any of you the value that you receive in return for your participation. And I'm also all ears as to suggestions that you have for improvements that we can make or topics that we should look to include in our next round of research. They're still being microphoned up. So to start our discussion, I thought I'd start out with a few facts and figures from our most recent study. So this is the global e-trading historical usage and volume. And this is the stat that Petra quoted this morning. And we see that the proportion of volume traded online and the proportion of investors trading online are both at about 75%. Welcome, everybody. So electronic trading continued its strong growth trend. And we do see that firms generating the highest volumes continue to be the heaviest proportional users. Those trading more than 50 billion annually execute about 76% of volume electronically, while firms trading less than a billion only trade 22% of annual volumes electronically. Now getting to the use of algo trading. It grew slightly in 2014, and we do see strong growth expected in 2015. 13% of FX users reported employing algorithmic-based trading models or execution tools. This is up from 11% in 2013, and it's actually more than doubled since 2010. And we do see hedge funds and CTAs as the most active users at 26% on average. Firms using algos executed 27% of their volumes through them, and hedge funds that use algos executed 33% of their volume this way, while corporates were the smallest and executed only 5% of volume using algorithms. And then I have a stat over to the right that shows the market penetration in algo execution tools. Is everybody ready? All right. Well, so having shown these stats, I'm curious as to why algo usage seems to be so low in such a super electronic market. Are you surprised by how low the numbers are based on the nature of FX trading? And I know that in our prep discussion, it sounded like, Andy, you may have been surprised by these figures, and Soren, perhaps you were not. Would either one of you care to elaborate on that?
Sure. As the FX market has transitioned closer to the equity markets, and you do have that fragmentation now. You see there is significant advantages to taking larger orders, breaking them down, and actually providing liquidity to the FX marketplaces as opposed to continually and constantly being a price taker. So as we've seen the use of algos go from maybe 10% in 2011 to only 20%, I would just expect that to grow even faster.
Mm-hmm.
Yeah, I think the reason why I wasn't too surprised was the cost of algos. When we have looked at the FX space, unless you develop your own algo and set it up, we might not know if a hedge fund is using algos. They might not even tell us, but in general, the market has not seen, due to the cost, a really breakthrough for every orders yet. I think with the new thing on fixing coming through, that market will be forced to look at it and said, okay, a 5-minute TWAP that was mentioned by speakers earlier is going to be the first entry into the to this part of the world for some participants. But I was not surprised it was that low yet, because it hasn't gotten everybody into it yet. And I think, do we even have, and that comes up later on probably, who is going to pay for the algos? Are we going to go out and buy them? Are we waiting for the buy side to develop their own, or the sell side going to develop and give to the buy side? But that's all part for later. But I was not too surprised.
Yeah, I think it's a given that people want to use algos to execute more and more. I mean, the question that I have in mind is much more, should it be provided by the banks, by the sell side, or should it be developed and bought by the buy side? From what I understand, actually, a number of algos which have been created, the business of providing algos by the sell side, by the bank, is pretty good, right? It's expensive, actually, you know it's expensive. But I think that even the regulators are looking into it. So the issue may be soon resolved, because regulators such as banks cannot do that. What I think the trend is going to happen is the people on the buy side are going to start to develop their algorithm. And the very fact that to execute well, you need to know what is your alpha, means that to borrow an execution algorithm from somebody else may actually be totally counterproductive.
I would say I'm not surprised, because we are a small trading company. So what we've seen, that we had some good relationship, in production with large brokers, and suddenly 2 years ago they shift attitude in terms of business development. Say on their side, it's easier to go in a deep and strong relationship with large other investment company than deal with small firms. Say, yeah, maybe you're gonna make money in 5 or 7 years, and we're gonna grow good business with you. However, we grow even better business now with the large companies. So we'd rather have this kind of relationship with big companies than small companies. So we are not invited in one conference anymore and stuff like that. It's really a shift in what is a business environment and how we can use this broker in terms of execution and algorithms. I think they have switched completely the way they want to anticipate that regarding the liquidity in the market, and they really want to focus on the way they can deliver the best algorithm for their main clients. That's really what we've seen.
Mm-hmm. John, you had expressed that you're somewhat of a skeptic. Perhaps you'd like to share. That's not what you said.
Algorithms are one of many ways to the FX market. The FX market is very different from the equity market. The equity market is one market that is regulated and sort out entire currency affiliation. The FX market is different because there are many ways to benchmark, algorithm, and so algorithms in some senses are another way of estimating because there's competition with the government.
Quite frankly, if you're a real money fund and you have 50 million to do, and Soren will execute it for you with less than 1 foot slippage, just by passing it to a bank, why are you going to do it using algo? So it's algorithms is one of many ways to execute in the FX market. We have a much broader choice than in the equities market, and that's why when you review the numbers, that every year people expect this massive growth in algorithms, but actually the next year it's going to 12, 13, 14, 15%. The foreign will execute a $50 million trade in one shot at a good amount.
Of course. Done that for years, so.
Yeah.
What conditions direct the buy side to use one or the other? And why is the buy side so willing to pay for this service? Maybe one of you guys could elaborate.
Yeah, and I think that goes back to your point. There are many ways you can execute. So when you're giving an order, that's the first thing you want to do. What's the best way for you to get this order done in the market efficiently? Maybe that is a simple risk transfer price over here in storm, but maybe it's not. Maybe it's an EM pair and the liquidity is not there right there in the marketplace. You don't have alpha in this order, perhaps, but you're more than willing to sit there passively, take a little bit of opportunity cost to now provide liquidity to the market, try and capture spread. So that's typically when I think algos are the best, not necessarily during volatile times, but more of times of illiquidity or times that you don't necessarily have alpha and you're willing to be a little bit patient to try to pick up that spread.
There is another reason why people use algorithms, because they're trying to prove that they got best execution, whatever that would be, whatever that means. So it's an interesting question as to, and one of the reasons they're trying to prove they got best execution is because we have very weak benchmarks in FX. And as those benchmarks improve, I'm not sure whether that actually favors the growth of algorithms because there's more PCA things you can do with it. Or else equally, I could argue that algorithms are less necessary. So we would transfer to a bank, and with better benchmarks, I know whether I get a good price or not. I don't know. But that's the other reason why people use algorithms.
Yeah, for us, for instance, we use these algos not really for benchmarking. We use it because we know by slicing orders we get better price, whatever it is. Whatever the position, the algos is fit for strategy. So we're re-engineering a bit this kind of algorithms to use it on a purpose for our strategies, not really on large asset managers trying to manage the large amount of money from their clients. It's really more focused if we can find even a good VWAP-based algos and we can adapt it to the time constraint you have. Let's say enter in a position in 2 hours, and you don't have your market impact in 2 hours. Instead of an asset manager will go for 1, 2, or 3 days around that for small medians. We want this kind of stuff, and we know with this algo we benefit from the quality of the execution or the speed of the execution. We would not be able to capture that manually. So that's typically the way we use the algorithm, which is quite different from what algorithmic trading will be done, because we're trading more on a short-term side.
There are other reasons also for using algos. I mean, you want to cover your tracks. You want to have as little market impact as possible. You don't want to show your hand. I mean, every time you show big sizes, you show your hand. I mean, it's clear.
You do. I agree with you. That's a great reason to use algos. And I'm not really there. The other way you can have a really good price is having a really good relationship with your bank.
Yeah, as long as the bank is allowed to do that for a while, right? I mean, it may come to an end, right? I mean, clearly, the regulators don't, like to see the bank less and less internalizing and more taking, passing the flow to the size of the market. So you should just go straight to the market, right?
Yes, equally, over time, banks, and it's true, there are pressures on banks, like Basel III, etc., to take that risk. But over time, they get better at managing that risk. I think that the end situation is that, again, algorithms is one way, but the others are risk transfer to the bank, which is the time-wise way, and benchmark and trading the benchmark is all the risk transfer.
But I think all what we're going to see is you will see a wider adaptation of algos in this space, because I think most institutions, at least most banks, has some kind of algo, their pricing capabilities. It's great. They put in something to generate our own price, whatever it is that feeds into, say, slightly different than the mid-market price. There's a little bit of differentiating factors coming into play there. But not all clients are going to want that, because they don't necessarily care about us knowing that they're hedging a purchase of a car or something. They're going to sell a 15 million euros or $10 million check, etc. And they don't care that we know it. Whereabout, if you have a proprietary trading model, as some of the big funds have, they have to keep a certain amount of the traffic away from you, because the worst thing is that intellectual property can be reverse engineered, and that's everybody's fear from a hedge fund side, from my knowledge at least. So they're afraid of, if they show their hand and give one institution too many trades in one direction, they can say, they're selling. Now we know, and we can guess what it is, and copy it, and therefore steal some knowledge, basically. So they will continue to use it, and also start taking more and more clients in and feeding them into this area about trading algorithmically, because, as Pierre said, we don't want to show our hand. And I think that's what we're going to see it. We are not going to see, I believe, this 95 to 100%, because there's still relationships and people who don't want to pay the extra fee because it doesn't matter for them. If you pay, you saw a number earlier for a simple T-Wop, they said $35, $45 per million. I tend to believe it might be a little lower now, but it has been there for sure. And that is in a euro dollar, 1 million, that's 0.3 to 0.4 ticks, basically. I can do better than that. I can sell them directly, 0.2 pips, flip it. I did better that way than using an algo. As well as taking into account, if I time slice it, how many tickets they do, what is my operational cost for processing 50 trades. If I have 50 trades that has to settle via CLS, that's a fee that has to be paid somewhere. And we know, sorry to say it, the banks are not going to pay it, because you still need to make a profit. So that comes out somewhere else. So there's a lot of things to take into consideration. But I think that the buy side will certainly be more and more involved in it. The key is, who's going to develop all these new algos? Yes, the banks have some, and they have also rolled out, and some banks have been a lot more active than ours in it. But we also have some companies here today that have developed algos and are selling it. And a lot of funds have been very active in building their own algos.
I'm even surprised why there's no more software providers which don't develop this suite of algorithms and sell them to buy-side clients, because you need to be able to analyze your short-term alpha, and then the mathematics is not that complicated, right? And you can run it from your own shop. Yeah. I'm surprised the bank even have any competitive advantage on that, because they don't have the technology. Bank cannot compete in technology. It's too big, right? I mean, too many firewalls, too many data centers, too many servers, and so on and so forth. They cannot quite compete in terms of talent, right? I mean, the best quant traders, can move at any time to any HFT, right? And then, so what else, right?
Yeah, I mean, clearly Market Factory is a software provider. We write algos and things, but I think the answer to your question is the most interesting problems in FX are mainly to do with the very highly fragmented market. And is that an algorithm? Yes, in that case we write algorithms. But in the equity sense of algorithms, I think it's a fairly limited market, because if people are really trading for alpha, for the alpha in foreign exchange, they'll probably write their own algos, frankly, because that's probably what you do. Period. Yeah. Because you think there's something unique about that. If it's generic, then I think that community probably is more interested in the risk transference model. And that's why it's not a huge market for people who want equity-style algos in FX right now, unless they want to write them themselves. Yeah, the more interesting problems are the fragmented market, getting to the right venue, and so forth.
I'm surprised that real money people don't use any. I mean, they don't have any alpha to protect, but they have large volumes to save money on.
And some of them do. And as I said, I think the reason they don't all gravitate to algos is because Soren will do them 50 million in one shot and just get rid of them.
Kind of going back in the evolution of algos from the bank perspective, I've seen great strides from the banks and a lot of effort to build out their algo suites. I think in the early days, they just took their equity algos, slapped FX in front of them, and now they had FX algos. But what I've seen since is just a robust effort to really provide the buy side with a suite of algorithms to cover us from anything from pure agency models to hybrid models to where we may interact with their internal liquidity if that's the best price. If it's not the best price, it'll route out to the different venues to find the best price available. On the backside of that, what's probably been even more impressive to me is the TCA reports that we get back from these banks in real time. We can actually stage an order into the algo, go into their single dealer platform, watch the fills come in real time, see exactly what venues they're being executed at, see the bid-ask spread, see if we're being executed on the passive side of the market or actually aggressing and crossing the spread. We can see where the markets are trending. We can actually get more aggressive or less aggressive within the platform. So to me, I'm really seeing a lot of strides in the algorithmic platforms that were being offered by the banks. And there are costs associated with it, but at least now we are controlling our executions. And that becomes a decision for us when we have an order. Should I do a risk transfer price? Am I going to get executed tight enough? Or am I willing to be a little bit more passive, try to capture spread, provide liquidity to the market, and pay a little bit of a brokerage fee, but on whole, I'm better off and my clients are better off. And one of the things that we do for every single one of our executions is we look at what is the risk transfer price, or what do we think the risk transfer price is on this order at this time. Then we stamp that, and that now becomes one of the many benchmarks that we look at when we're looking to see how we actually did.
Yeah, my experience that with algos, it's and relationship with banks always the same. So you'll start an algos is going quite well. There is a bank environment providing you that. And as soon as it starts to go well, then the banking system begins to be a bit slow. So finally the competition coming up, and then they have to refit their own system, say, yeah, let's wait, we need to upgrade our system. Then a new algorithms coming in the market, and then it's going better than the competition, and you're reaching the 0 point latency and so on. It's a bit like a game like the Tour Eiffel. You paint it, and when it's crude steel, there is corrosions, and when you finish to painting it, you need to repaint it again. It's always the same you have with algos. So don't expect too much from my experience between more than 6 to 8 months, profitability or quality of execution. After that, you have to refit your own model because market conditions have changed, or whether you have to discuss with several banks to understand how you can readapt new algorithms or a new way of using your algorithms, to a faster market or faster, more short-term volatility and so on. It's always this kind of discussion you have at the end, and you say, yeah, well, this algo was quite profitable for a moment, and we improved the TCA and so on, but finally the TCA went up because there is some unexpected volatility in the market. And so we need to find a broader algorithm, some with exception handling and so on and so on. I don't know what are your expertise on that, but it's something we have in our side because we're designing our algos, but definitely on the development side because people rely on your production. So typically you need to figure out what's happening directly in the market to make it function.
You develop your own algos.
Yeah.
And they last 9 months.
Yeah. Well, the trading, because it's made for alpha. It's not made only for execution.
I think that's actually a pretty good lifespan for an algo, 9 months, because the market figures out. If you see a certain behavior in the market, you see it, everybody looks at it, and people analyze it. There are a lot of people analyzing every single trade coming in, everywhere. And they look at that and see how can we generate new algos that can capture potential alpha, same way as you have created yours. So 9 months, yes, you constantly have to retool an algorithm if you create one for generating revenue. If you do it for spreading risk out in a different way, you could probably use the same one for a long time and tweak it a little bit, but the concept are more or less the same. But you have to, in general, you have to adapt to the market. It's constantly changing. So
So do you think it's fair to say that recent events have highlighted potential weaknesses of algos?
I think everybody who has been in the market for the last 2 weeks would have seen that. Yes, you certainly have seen that. I didn't read some of the gossip pages that came out today about what had happened and comments on it, what had happened last Thursday, or Thursday a week ago, rather. But there were certainly things that showed that the algos are not created well enough sometimes. Both from a market-making perspective, where you can't warehouse too much risk.
I think what we have seen over the last, obviously currently over the last 2 weeks, is the bank pulling back, right, and getting wide, and leaving really the high-frequency shops showing liquidity, the algorithm guys, right. So ultimately, I think the algorithmic shops are the ones saving the day these days, at least in Swiss, right.
Yeah.
The banks are comfortably wide. And that's something that you have to deal with, right? I mean, essentially, you rely on the banks to serve you, and at the end, they have their own shareholders to hold, right? And they are looking at their own profitability. And Andrew, when you said, now you're getting all these wonderful things, right? Well, yeah, but another 6 months you're going to find that, well, they are cool, but it's not really, it's the first layer. And so you discover a new piece of science, but that science exists, right? And there is some convenience. But again, I'm surprised that there's not a niche players which are willing to provide with asset managers with tools to execute. And because paying 0.1, 0.2 pip extra, how much actually is the charge for executing to an algo by a bank?
It depends, and we saw it this morning, it depends on what type of algo. I think it goes from anywhere from 0.2 pips to almost a full pip, depending on how smart.
So here you go, you can get the pip on
Well, you can get
$100
that.
million. I would go for it.
Yeah, but you may be able to do that with, as I say, a close relationship and risk transfer. So yeah, I agree. Algos have their place, and we're like everybody else involved in that. But by the way, on your question about the Swissy move to a week and a half ago, I mean, I think everybody who is in the market in any role, be it a technology provider or proprietary trading or bank, we're still working that one out. I mean, the questions really which upset any algo are things like the finality of trades. That's the big thing that's come out of that. And if you have a trade as part of an algo or any other data structure, and then hours or God forbid days later you're still trying to work out what the price was, that's pretty grim and upsets everything.
It does.
And until that problem is solved, I think the jury's out as to what the role of algos, risk transference, or whatever is.
Yeah, but also the same that we have regulators looking at algos from different banks now, because I don't know exactly why I haven't read the legal part of it, but it's from certain banks where they've looked at it and said, okay, we want to know more about your algo. Mm-hmm. And it shows again from a bank perspective, you have to be very, very careful about what you are able to provide to clients, no matter how sophisticated they are or not, because people come back and say, this is not correct. It looked very fine to us. We disclosed everything. No, but you didn't do it this and this way, because regulators do not always necessarily understand how that specific part of the market worked 5 years ago, because they will come again 5 years from now and look back at it, unfortunately. That's what we have seen.
Yeah.
And that is the biggest challenge, I think, in the FX market. Being able to protect yourself for things that happen in the future, and that also adheres to algos.
That's a perfect segue to the next question I wanted to discuss, which is how can a largely ungoverned algorithmic market be taken towards a more regulated and protected environment? Do people need to know how these algos are working? Is there a right? Is there a wrong?
I think, if you have a client want to trade with you on algo, you have to describe what it's doing and give the client have to sign off on it. And you brought it up, Andrew, that you can say, if you're going using a bank's algo, I want to have the bank's internal liquidity, yes or no. Because if you don't want to use the bank's internal liquidity, even though it has the best price, that's fine. If you want to just use it as a DMA for FX, then that's fine. But you have to disclose that, and you say you might have, from a client's perspective, missing part of the market, but you also know that the bank necessarily won't see what's going on, and that's good. But it all depends. We have to tell the clients what they're getting into and try to explain to them as much as we can in detail how it works. Doesn't mean you're giving them the whole writing of the specs for it, because that wouldn't work.
Yeah, I would say I had some, when you go some kind of high-frequency trading discussion and you grab some paper on tables during the meetings, and I end up one day with a kind of 50-pager relating all the algorithms in the market, describing 2-page by algorithm, making think myself, why we should have some kind of ISDA around, you use an agreement and there is legal paper, and for each algo you have 50 pages to read regarding the legal usage of the algorithm, and you agree to sign all of this. Because at the end, that's what will happen if you want to regulate the algo. So the algo is a service, so you pay for a service, so it has to be regulated. It's not just an execution and a guy at the phone and someone trading a price with you and trying to improve his price and his margin with the call. So if there is regulation, definitely there will there will be some benchmark around it. So what is the benchmark today? It's the same, another algo. So that's the problem. It's the execution shortfall we have. So everyone is using this kind of discrepancy between the realized price in the algorithms and what should have been in the market within discarding the market impact also. So it's this kind of stuff we may end to if we listen to the regulator. I don't know how traders will see that in banking environment, but I think that it's like crazy stuff if you're starting to deal, or you do it before. So knowing your client, you say, yeah, you agree to this kind of algorithm, yes, and it's like a common framework and global general agreement you have with your clients.
I would say, it's very important to know exactly how the algorithm works. You want to know what venues it's going out to, why it's choosing those venues, and it's really important to see that on the back end through the TCA to say, hey, there's a pattern here, it's always going to this venue, why? And you need to ask those questions, but that's also, I feel, on us to make sure that we're getting quality executions and these algorithms are working as they're supposed to. So, I definitely think if you're using algos, you absolutely need to know how they work and why they work that way.
Well, so essentially you say to everybody how they work, right? So it's information for everybody in the market, right? So, great. At least when you used to pass your risk over a phone call, nobody knew about it, right? Except the other guy on the line and maybe his buddies, right? But that was a small club. And now, the entire algo is in public domain.
Well, how the algo would work would be public domain, but not that you're using the algo at that specific time. So it's more of a roadmap to say this algo is going to execute your order this way, but nobody knows. There's walls up in the trading desk where when I'm trading in an algorithm, my coverage doesn't even know I'm trading it until I'm finished, and then they would actually get a notification that I was done the order. But while I'm trading it, nobody knows I'm trading, especially if I indicated I want to be agency only model, where I'm not even interacting with the bank's internal liquidity.
I think we have to distinguish what this algorithm is that we're talking about. I mean, if the algorithm we're talking about is an algorithm which is simply choosing the venues according to a formula, the lowest rejection rates, the historical fill rates you've had, and the lowest execution shortfall, I mean, that's publishable. I mean, and there you're not trying to generate alpha necessarily from the FX. You're trying to hedge something. And that's a perfect example where you have a choice of doing it that way, through an algorithm, or going and doing a risk transfer. And as you said, you can choose between them. The kind of algorithm I think Pierre-Yves is referring to is the kind that usually a shop will want to write themselves, because there's some secret sauce in it where they're generating alpha from the FX. And there, in the first instance, we as a technology provider, for example, can provide an algorithm, which we do, to do sort of that sort of find the best, lowest rejection rates, et cetera, et cetera. All one can do as a technology provider is provide a framework for Pierre to write his special algorithm, which I think is alpha generating for the FX. I'm simplifying it, but in general, that's the distinction.
But Andrew, when you have this large volume to push in the market, you are never tempted to hire a couple of guys which could do that for you and derive some extra value for your clients. I mean, I'm assuming you do very large amounts, right? And technology is the big difference from, I don't know, 10 years ago. You have people who provide you technology. There is electronic access to anyone. You have a bunch of ECNs. I'm surprised that real money, you're real money, right? Mm-hmm. Real money people don't integrate that function and says, hey, we are big enough to have a couple of, nerds, work for us and do it in-house. And the regulator would love that, right? The regulator wants every buy client go straight to an open market, public things, They can see the bid, they can see the offer, and all interest coming, right? Maybe half a dozen, a dozen of them, of the CCN, right?
That would mean you would create a kind of a different market setup, because I assume the way Andrew does it today, he basically signs up using a bank as his prime broker, so it then goes in and executes that way, because that's the only way you can get access to all of the markets. If you, on top of that, put a potential alpha generating, algo behind it, say a little sharper maybe than what we currently have access to, that can have a potential negative impact on that bank's name, because if it seems to be too sharp, for other people say, we don't like to price you anymore. So the bank can say, we don't like to price that. It's a fine balance, and said, we expect when we deal with a company that develop their own, it is sharp, because that's a business. They are going to be the best and the fastest and the quickest to the market. And yes, it can be flow hard to deal with, but if I price them directly, I know that, and that's up to me to take that risk. If I just create a pass-through, I will now generate something that doesn't look good. Whoever gets dealt on my behalf now, they're going to come back to me and say, I don't like this flow, we can't deal with you anymore, or we're going to widen you out, not a good liquidity partner anymore. So that's up to me, and I think that can be the danger sometimes. And that's a balance we have to figure out. But the key is algos will pick up, and everybody will have a different way of utilizing them.
So we have 2 minutes left, and I have one last question for you guys. What about the future of algos, the next generation, with innovation and artificial intelligence coming into the markets? How can current algos be refined and improved to be taken to the next level?
Yeah, you're the forefront of this.
Well, it's a of course, we have tools. I mean, there are some methods, and which has been available in other fields of science, right? You can bring back. I mean, actually, finance has been very good at taking stuff from other fields and to apply it. And but then, it goes back to my, what I keep saying. It's kind of homegrown effort, because these techniques are very cutting edge, and they have to be understood and worked on. And also they are usually tailored to your own flow, your own business, right? And it's why it's very difficult for a bank to be willing to have the execution algo for everybody, right? Even if there's a couple of bells and whistles to tweak here and there. My view is yes, there is some techniques that, we're talking of pattern matching and some basic, artificial intelligence stuff, but it is a homegrown effort.
It depends on the cost and the return on the investment. That's the end of it. If the bank does it, it has to make sense for them.
Yeah, I think the bank, if they were to use it, or I think some of them are doing it, they will keep it internally to try to make it an advantage to the market, and not showing and not distributing this kind of deep learning algorithms, minimization functions everywhere, self-learning or intelligent stuff. Typically because if they know they can cross a lot of information internally against their client, against their market, so typically if they were to build an algorithm, it will anticipate some kind of pre-sales environment or you know, or pre-trade environment, and also the execution side, saying, if I know against this counterparty the execution is not going well all the time because there is a lot of back office problem behind, no, I will reject some of the counterparties, and not only because in pre-trade it's working, but it's because my impact in terms of TCA or whatever, the algorithm would show this kind of stuff. And most probably if they would have this kind of futures development, I understand.
I think the next generation of algorithmic development relies very much on the market data that can drive it. Ultimately, these algorithms are only as good as the market data that drives them. If I had to be a betting man and say where the next innovations are, I mean, FX market data is very hard to come by. I kind of like it that way, actually, because it gives a bit of a business. But in reality, the broader picture is that, I mean, I know that Dimitri keeps talking about generating market data as a last trade from all the different platforms, etc. I disagree with that will happen, but if it did, that would be a major change. Market data is the key to, is the missing piece in FX, the biggest missing piece in FX.
I'm afraid we may have to leave it there. We're well over time. I hope there's no burning questions from the audience.
Was that an invitation or a
Well, I was hoping maybe one. Well, thank you, everybody. This was a really fun panel. Thank you so much.